Everyone wants to know the same thing. Where is Nifty headed tomorrow? Will it surge to new highs, or will the bears take control and drag it down? Traders, investors, and even casual market watchers are glued to their screens, refreshing charts, scanning news feeds, and analyzing data that barely scratches the surface. The truth is, predicting tomorrow's movement isn't about technical charts or simple patterns. It's about understanding a system far bigger than any individual trader or algorithm. For decades, India's stock market has fascinated the world. The Nifty 50 isn't just an index, it's a mirror of the economy, a barometer of investor sentiment, and often a battlefield for hidden forces that ordinary investors never see. Yet every morning, millions act as if tomorrow will obey their expectations. They set stop losses, place orders, and hope their analysis will give them an edge. But there's a reason the market never moves according to hope, and that reason isn't what you think. The system isn't chaotic, it's engineered. The swings you see, the sudden spikes and crashes, they're not accidents. Behind the scenes, massive institutional players, high-frequency trading algorithms, and policy interventions orchestrate movements in ways that make predicting tomorrow's Nifty seem impossible. And yet, patterns exist. If you understand how the gears turn, you can glimpse what might happen next, not as a certain prediction, but as a probability shaped by strategy, influence, and control. Tomorrow isn't just another trading day. It's a continuation of a story that started years ago, driven by decisions most people never witness. While millions of retail investors try to follow trends, a smaller, invisible group makes the calls that shape the market's path. They don't gamble, they calculate. They don't react, they anticipate. And the question isn't whether Nifty will rise or fall tomorrow. The real question is, who decides which way it moves and why? Before we dive into the numbers, the charts, and the technical indicators everyone quotes, we need to understand the bigger picture. Because in the market, knowledge isn't just power, it's survival. Tomorrow's Nifty movement will hinge on a mix of forces most retail traders never consider. At first glance, you might focus on charts, candlesticks, and momentum indicators, but those tools are only fragments of a much larger picture. Real movement comes from liquidity, institutional positioning, and macroeconomic triggers, the hidden levers that quietly steer the market while headlines scream about gains and losses. Let's start with liquidity. Every trading day, billions of rupees flow into and out of the market. Mutual funds, foreign institutional investors, or FIIs, domestic institutions, and even central bank actions dictate where that money goes. When large funds decide to increase exposure to equities, Nifty often rises, not because the economy suddenly improved, but because the inflow itself creates demand for shares, pushing prices higher. Conversely, when funds retreat or rebalance, the index can fall abruptly, regardless of news or fundamentals. Institutional positioning is another invisible force. The Nifty 50 isn't just an index, it's a game board. Large players place enormous bets using derivatives, futures, and options. They can create artificial support and resistance levels that appear on your chart as if the market itself respects them. Tomorrow, if institutional traders have set positions at certain strike prices, Nifty is likely to oscillate around those levels, trapping retail traders in a psychological tug-of-war. And don't be fooled by intraday spikes. They're often liquidity plays, designed to trigger stop-loss orders or margin calls, allowing the smart money to profit from panic. Macro signals matter too, sometimes subtly, sometimes explosively. Overnight moves in global markets, RBI policy hints, inflation data, corporate earnings, and even currency fluctuations feed into market sentiment. But here's the crucial part. The market doesn't just respond to these signals, it preempts them. Sophisticated traders know what the central bank, FIIs, and large corporates are likely to do before the public can react. They position themselves ahead of news, effectively moving Nifty in advance of any official announcement. And the irony is this: while retail traders obsess over daily trends,
tomorrow's Nifty might already be shaped by decisions made weeks ago. The index behaves like a well-oiled machine, following a plan that few understand but many participate in unknowingly. To predict its next move, you can't just follow charts. You must read between the lines, watch the flow of capital, and anticipate the strategies of the invisible operators controlling the game. And yet, there's hope. For those willing to see the market for what it really is, tomorrow's movements are less random than they appear. You don't need to guess the exact number. You need to understand where pressure points exist, where liquidity will concentrate, and where institutional actions will guide price action. To forecast tomorrow's Nifty movement, we must examine today's market positioning, the footprints left by traders, institutions, and foreign investors. Every tick on the index tells a story if you know how to read it, and right now, the story is more revealing than most realize.
Start with open interest in derivatives. Nifty futures and options aren't just instruments for hedging, they're tools for signaling intent. Large concentrations of open interest at specific strike prices create invisible floors and ceilings for the index. Tomorrow, these strike levels act like magnets. The market tends to oscillate toward them as institutions balance positions and traders adjust hedges. For example, if significant put options are concentrated at 21,500, Nifty may find support around that level, even if broader sentiment is bearish. Conversely, heavy call option concentrations can form resistance levels, limiting upward momentum. Next, consider FII and DII activity. Foreign institutional investors, who control vast amounts of capital, often drive Nifty's short-term trends. Their net buying or selling today can indicate where the index is likely to drift tomorrow. Domestic institutions, on the other hand, often act as stabilizers, counterbalancing extreme swings. By watching the net flow of funds from these key players, you can anticipate whether Nifty will test support zones or break resistance levels. Volume analysis is another subtle but critical indicator. Not all volume is equal. High volume at market highs or lows tells a story of conviction. If Nifty rises on increasing volume, it often signals institutional accumulation, hinting that tomorrow could start with bullish momentum. On the other hand, if Nifty drifts lower on heavy volume, it often points to distribution, smart money offloading positions before the broader market realizes the trend. But perhaps the most crucial clue comes from market sentiment itself. Traders' reactions today reveal fear and greed patterns that algorithms and institutional desks exploit. For instance, if retail investors are overly bullish, sophisticated players might engineer minor pullbacks tomorrow to trigger stop-loss orders and lock in gains. Conversely, if pessimism dominates, a sudden rally could surprise retail traders, fueled by planned institutional buying at perceived bargain levels. Here's the critical takeaway. Tomorrow's Nifty isn't random. It's the product of today's positioning, liquidity flows, derivatives concentrations, and sentiment cues. By analyzing these elements together, you gain a probabilistic edge, understanding not exact numbers, but likely zones of support and resistance, potential momentum swings, and the pressure points that will shape trading decisions. Tomorrow's Nifty will reflect all of these factors, the invisible tug-of-war between bullish and bearish forces, orchestrated by players far larger than the individual trader. The key isn't trying to predict the exact number, it's seeing the battlefield, understanding where the battle lines have been drawn, and positioning yourself to navigate them intelligently. Tomorrow's Nifty movement won't be determined by India alone. Global markets are now inseparably linked, and overnight cues often set the stage for the trading day ahead. Asian indices, U.S. futures, crude oil prices, and currency fluctuations all feed into Nifty's opening sentiment. A sudden spike in the Dow or Nasdaq can trigger instant buying interest, while weakness abroad may lead to cautious selling. Crude oil is particularly important.
as India imports nearly 85% of its oil. Any spike in international crude prices immediately raises inflation concerns, impacting investor sentiment. A rise in crude can pressure energy and industrial stocks, dragging Nifty lower, while a decline may create a short-term rally. Similarly, the rupee's movement against the dollar signals FII confidence. A weakening rupee can trigger capital outflows, whereas strength can support inflows and stabilize the index. Macroeconomic announcements also matter. Tomorrow, even minor updates on interest rates, government policies, or corporate earnings can amplify trends already in motion. But here's the critical insight. These events rarely move the market alone. Their impact is magnified or muted depending on how liquidity, derivatives, and institutional positioning align. A policy announcement might look bullish in the news, but if institutions have already positioned for a pullback, the index could defy expectations. The most crucial factor is human psychology, fear and greed at a global scale. Algorithms, high-frequency trading, and institutional strategies all exploit these emotions, amplifying volatility in ways retail traders can barely anticipate. Tomorrow, Nifty will move not just according to numbers, but according to perception. The slightest shift in sentiment can trigger sharp moves, while well-placed institutional trades can absorb shocks and maintain stability. So what does this mean for you as a trader or investor? It means tomorrow is less about certainty and more about preparation. Watch the key support and resistance zones, track derivatives concentrations, follow liquidity flows and FII activity. Pay attention to global cues, but understand that the market often moves ahead of the news, not in reaction to it. And above all, respect the invisible hands shaping every tick on the index. Predicting Nifty tomorrow isn't about guessing a number. It's about reading the signals, understanding the machinery, and positioning yourself intelligently in a market engineered by forces far larger than any individual. Every trade you make, every order you place, and every strategy you follow should account for this reality. The market will move. It always does. The question is whether you will move with it wisely or be caught off guard. Take the time to understand these forces, and you can approach tomorrow with clarity instead of fear, strategy instead of guesswork. If you found this analysis valuable, hit the like button, subscribe for daily market insights, and turn on notifications because tomorrow's Nifty won't wait, and neither should you. Equip yourself with knowledge, anticipate the moves before they happen, and stay ahead of the game.